Banks don't lend money, they create it, demystifying monetary and banking terminology. Overview. My presentation addresses three main problems. 1. What does a bank actually do when it lends money? We know banks create money, but how does this process work? 2. Evaluating the three theories of bank lending proposed by Richard Werner. Which theory is true, or when is each applicable? 3. Examining the terminology. Terms like lending and loans seem to mystify the actual process of money creation. Why is this the case? All citations in brackets are included in a reference list at the end of the presentation. Structure of the presentation. 1. How banks create money. This refers to account money, not physical paper money, as shown in the illustration. 2. Three theories of bank lending. Each theory corresponds to a specific banking and monetary system. 3. Demystifying terms. I will propose alternative terminology to clarify the process. What happens when a bank lends money? When a bank lends money, it creates money. But how does this work? The process is explained in the paper Money Creation in the Modern Economy by three economists at the Bank of England, who state: banks do not act simply as intermediaries lending out deposits that savers place with them. This was further elaborated by economists at the Danish Central Bank in a subsequent paper and press release by Governor Hugo Jansen of Denmark's National Bank. He stated, banks create deposits and thus money when providing loans. Example of money creation. Suppose I take out a loan of 800,000 kroner. 1. The bank creates a deposit, 800,000 kroner is added to my current account, a bank liability, as the bank owes me this amount. 2. The bank creates a loan account, the same amount, 800,000 kroner, is entered into a loan account with a minus sign, a bank asset, as it represents my debt to the bank. Thus, the bank has created an equal liability and asset without transferring any funds. This extends the bank's balance sheet by 800,000 kroner. No other depositors' funds are involved. Michael Kumhoff, a senior research advisor with the Bank of England, explains this process succinctly. When a bank makes a new loan, it creates a new loan entry on the asset side of its balance sheet and a matching deposit on the liability side. Lending plus clearing equals money creation. After the loan is made, the borrower spends it. For example, I might purchase an apartment, transferring the 800,000 kroner to the seller's account. Does this mean the bank needs to cough up the money? No. Payment systems, like Denmark's nets, facilitate clearing, matching outgoing and incoming payments across banks. Only net differences are settled. This system enables banks to extend loans without holding significant reserves. Money creation and destruction. Loans increase deposits. When a bank creates a loan, it adds deposits to the borrower's account, increasing the nation's money supply, cash plus deposits. Repayments decrease deposits. Loan repayments reduce the borrower's deposits, effectively destroying money. Unchecked lending fuels asset bubbles, e.g., real estate, stocks, and drives boom-bust cycles, making bank lending a major macroeconomic force. Confusion in terminology. The term lending is misleading. When I lend my neighbor a lawnmower, I don't create a new lawnmower in the process. Yet, banks create money when they lend. Could this terminology persist to justify interest charges? Traditionally, interest compensates savers for the temporary unavailability of their funds. However, this rationale doesn't apply to banks. Three theories of bank lending. 1. Financial intermediation theory. Banks gather deposits from savers and lend them to borrowers. 2. Fractional reserve theory. Banks retain a fraction, e.g., 10%, of deposits and lend the remainder, expanding the money supply over multiple cycles. 3. Credit creation theory. Richard Werner. Banks create money by adding digits to customer accounts, requiring no reserves. Werner's 2014 study provides strong evidence for the credit creation theory, relegating the other two to historical contexts. Theories in banking systems. Each theory aligns with a specific banking system. 1. The intermediation theory applies to warehouse banks where gold or valuables were deposited and lent. Rarely relevant today. 2. The fractional reserve theory fits gold-based banking systems, where banknotes were issued against gold reserves. 3. The credit creation theory fits modern banking systems dominated by account money. Deposits are created via bookkeeping without physical reserves. Modern banking and misleading terms. Many banking terms obscure the reality of money creation. Below are common terms and their clearer alternatives. Lending or loans, these terms suggest that borrowed money is someone else's savings. Instead, use the term money creation. Loanable funds or funding, these terms imply that banks need to gather funds before lending. Instead, refer to this as money creation. Deposits, this term misleadingly suggests something physical is deposited. Instead, describe the process as number coordination. Repayment of loans, this term implies returning money to the bank. Instead, use money destruction, as repayment reduces the money supply. Conclusions. 1. Understanding is crucial. Bank lending drives economic cycles, wealth concentration, and financial instability. 2. Call to action for scholars. Economists must critically evaluate outdated theories and terminology, aligning them with modern banking practices. 3. A more equitable system is possible. Stripping banks of the power to create money could mitigate crises and foster economic stability. Thank you for your attention. For further reading, refer to the references provided.